Imagine it's a Tuesday morning in July 2003. You're a small business owner in northeastern Italy, Verona specifically. You have 12 employees, a payroll due in 4 days, and $47,000 sitting in your business account at UniCredit. You also have receivables coming in from 3 clients, a supplier invoice due Thursday, and a standing order for your warehouse lease that processes automatically every first of the month. You walk into your shop at 7:45 a.m., and your point of sale terminal is blank. Not frozen, not slow, blank. You try a reboot. Nothing. You call the bank. The automated system won't connect. You try online banking. The page loads halfway and stops. You call your accountant. He's getting the same thing. You call 3 neighboring businesses. Same story across all of them. The power is on. The internet is on. Everything in your life that runs on electricity is working perfectly, except anything that touches the financial system. By 10 a.m., Italian state television confirms it. A massive grid failure linked to an overloaded transmission line from Switzerland has disrupted not just electricity in parts of the country, but the entire interbank settlement network that coordinates electronic payments across the region. ATMs are dark, card terminals are offline, wire transfers are suspended, PayPal won't process. Your bank's mobile app shows your balance clearly, right there on the screen, $47,000, exactly where you left it. You cannot touch a single euro of it. Not to pay your employees, not to pay your supplier, not to buy lunch. The money exists. The money is real. The number is accurate, and it is entirely, completely, functionally inaccessible. By noon, a line has formed outside the one currency exchange bureau in your neighborhood that keeps a small amount of physical cash on hand. By 2 p.m., that cash is gone. By evening, the only businesses still operational are the ones whose owners happen to have physical cash in a drawer that morning. The Italian grid crisis of 2003 lasted approximately 18 hours. 18 hours, and in those 18 hours, one of the most sophisticated economies in Western Europe discovered that its entire transactional infrastructure rested on a single, invisible assumption that the digital layer would never go dark. The assumption held until it didn't. This is not a story about bank failure. This is not about insolvency or bail-ins or fractional reserve mathematics. This is about something more immediate, more plausible, and in some ways more disorienting. This is about what happens when digital banking doesn't fail in the legal sense, but simply stops working. And this is about the question almost nobody asks before it matters. Where is your money when the lights go out? This is historical and structural analysis. It is not financial advice. It is not a recommendation to take any specific action. Every individual's circumstances are different. Consult qualified professionals before making decisions about your financial situation. What follows is a documented examination of what has worked, what has failed, and what the architecture of modern digital dependency actually means for your savings. If you're enjoying this deep dive into the story, hit the subscribe button and let us know in the comments from where in the world you are watching from today. Let's begin with what most people don't understand about the modern payment system, because the misunderstanding is almost universal and it matters enormously. When you tap your card at a grocery store, most people imagine a simple transaction. Money moves from your account to the store's account. Clean, instant, direct. That is not what happens. What actually happens involves your card communicating with a payment terminal, which routes through a payment processor, which queries your bank's authorization system, which checks your account balance against a real-time ledger, which then sends an approval code back through the processor back to the terminal, all within approximately 1.5 seconds. The actual settlement, the moment the money genuinely moves, happens later through a separate interbank clearing system that processes in batches, often overnight. At any point in that chain, if any node fails, the transaction fails, not because you lack funds, because the infrastructure that communicates the existence of those funds is unavailable. This architecture has several critical vulnerabilities that the public almost never thinks about. The first is centralization. Modern banking runs on systems developed in the 1970s and 1980s, patched and extended over decades. Many major banks in the United States and Europe still run core systems on COBOL, a programming language developed in 1959. These legacy systems are not redundant in the way most people assume. They have single points of failure that when they fail completely. The second is interdependence. Banks do not operate in isolation. They settle payments through shared infrastructure. In the United States, this means systems like Fedwire and the Automated Clearinghouse Network. In Europe, it means Target2. In the United Kingdom, CHAPS. These are not backup systems for each other. They are the same system. When they experience disruption, the disruption is systemic. The third is the cyber surface. In 2023, the United States financial sector experienced over 1,600 reported cybersecurity incidents. The Federal Reserve has identified cyber disruption as one of the top systemic risks to financial stability. In 2012, a distributed denial-of-service attack disrupted Bank of America, JP Morgan Chase, Wells Fargo, Citigroup, and U.S. Bancorp simultaneously. In 2021, a cyber attack on a Florida water treatment plant demonstrated how quickly physical infrastructure could be targeted through digital entry points. The financial system is not separate from this risk, it is the highest value target that exists. The fourth is power dependency. Every digital payment system, every ATM, every card terminal, every banking server runs on electricity. Extended power outages don't just inconvenience consumers, they disable the entire transactional layer of the economy. In 2012, Hurricane Sandy knocked out power to approximately 8.5 million customers across the eastern United States. ATMs in lower Manhattan ran dry within hours. Businesses that couldn't accept cash stopped functioning entirely. People with thousands of dollars in their bank accounts couldn't buy water. Here is the structural reality that follows from all of this. In a modern economy, the average person carries less than $40 in physical cash. Some surveys put the figure lower. In Scandinavian countries that have moved most aggressively toward cashless transactions, a significant portion of the population carries no cash at all. This represents a complete transfer of transactional dependency from a physical medium that functions independently to a digital medium that requires uninterrupted operation of multiple interconnected systems. In normal times, this is fine. The systems are reliable, the convenience is real, but the word reliable means something specific. It means the system works almost all of the time. Not all of the time. And in the gap between almost all of the time and all of the time, there is a window in which the money you believe you have cannot function as money at all. History has shown us exactly how that window opens. And history has also shown us what survives inside it. The 2003 Italian grid failure lasted 18 hours. 18 hours is manageable, disruptive, but manageable. But outages of financial infrastructure don't always resolve in 18 hours. In 2012, Royal Bank of Scotland experienced a catastrophic IT failure after a software update corrupted its payment processing systems. For 2 weeks, approximately 6.5 million customers could not access their accounts. Direct debits failed, mortgage payments didn't process, people couldn't pay rent, employers couldn't meet payroll, the bank was not insolvent, the money existed, the system was simply down. 2 weeks. In 2019, TSB Bank in the United Kingdom attempted a migration to a new banking platform. The migration failed. For over a month, 1.9 million customers experienced disrupted service. Some were locked out of accounts entirely, others saw incorrect balances, online banking was intermittently inaccessible, the bank was solvent, the deposits were real, the infrastructure simply couldn't function. In 2021, a failure at the Federal Reserve's FedNow predecessor systems disrupted interbank settlements across the United States for several hours, affecting payroll processing and wire transfers for thousands of businesses. The story barely registered in mainstream news. These events are not exotic. They are routine. They happen, they resolve, they recede from memory, until one of them doesn't resolve, until one of them cascades. And here is where we need to understand what happened in several countries, not during banking insolvency, but during infrastructure events that showed exactly which forms of stored value survived when digital systems failed. In Puerto Rico, after Hurricane Maria in 2017, the banking system remained technically solvent, the money was there, but power outages disabled ATMs across the island for weeks. Card terminals were inoperable. The Federal Emergency Management Agency distributed physical cash because there was no other way to transact. People with thousands of dollars in bank accounts could not buy medication, could not buy food, could not pay for transportation. The people who survived those first weeks with their basic needs met were the ones who had physical cash on hand or who had stored value in physical form outside the banking infrastructure. In Venezuela, as the banking system degraded through hyperinflation between 2015 and 2019, electronic transactions became unreliable for a different reason. Point-of-sale systems frequently failed to communicate with banks due to degraded infrastructure. Dollars, both physical and stored outside Venezuelan banking, became the functional currency of survival. In Lebanon, beginning in 2019, when the banking system froze dollar withdrawals, people discovered that physical dollars held outside the banking system, in homes, in stored form, were worth dramatically more in transactional power than the identical sum held in a bank account. The number on the screen didn't change. The purchasing power available was completely different depending on where the money existed physically. The pattern across all these cases is identical. When the digital layer fails, for whatever reason, what functions as money is determined not by the number on the screen, but by the form in which value is stored. So the practical question becomes, where do you store value that functions when the digital layer goes dark? 1. Physical cash in appropriate denominations, held outside a single location. This is the most basic answer, and the most resisted. The resistance comes from the opportunity cost of holding cash, its vulnerability to theft and inflation, and the cultural awkwardness of keeping significant amounts of physical currency outside the banking system. The historical record doesn't particularly care about any of that. Physical cash is the only universally recognized, immediately transactable, infrastructure-independent store of value in a modern economy. When the Italian grid went dark in 2003, cash worked. When Hurricane Sandy disabled the northeastern United States, cash worked. When TSB locked out 1.9 million customers for a month, cash worked. When Lebanon froze dollar withdrawals, physical dollar bills in circulation worked. The denominations matter. In a disruption event, businesses that accept cash often have difficulty making change for large bills. The historical record from natural disasters and infrastructure outages shows that small denominations, 20s, 10s, and 5s, function more effectively in the early hours than hundreds. The location matters. Cash stored in a single location is a single point of failure. In a situation where access to your home is disrupted, or where your home itself is compromised, cash held only at home is no more accessible than digital funds. People who navigated financial disruptions most effectively have historically kept modest amounts of cash in multiple accessible locations, not for convenience in normal times, but for redundancy in abnormal ones. The amount matters. There is no universal number, but the historical benchmark from documented disruption events suggests that enough to cover 2 to 4 weeks of essential expenses, food, medication, fuel, represents the difference between managed disruption and crisis. This is not a large amount for most households. It is simply an amount that almost no household in a developed, digitized economy currently holds in physical form. If you find this story engaging, please take a moment to subscribe and enable notifications. It helps us continue producing in-depth content like this. 2. Precious metals in accessible physical form. This is not about investment. This is about stored value that exists outside any digital infrastructure and retains recognized worth in exchange contexts. The specific form matters enormously, as the historical record makes clear. Gold and silver coins in recognized denominations, American eagles, Canadian maple leafs, British sovereigns, are more immediately functional than bars or bullion of unusual form because they carry recognized face value and are more easily authenticated by non-specialists. In a disruption context, a 1-ounce silver coin is a more practical transactional tool than a gold bar because its unit value is closer to the price of everyday goods. The historical function of small denomination precious metals as a transactional bridge is well documented. In the aftermath of the Weimar hyperinflation, as the currency collapsed, silver coins circulated as functional money while the official currency degraded. In Argentina in 2001, people who held physical silver were able to trade it at local markets during the weeks when banking was frozen. In Zimbabwe, foreign coins, particularly South African rand coins, circulated physically as transactional instruments when the banking system could not function. The limitation is important. Physical precious metals are not liquid in normal times. In a grocery store during an ordinary week, a silver coin is not useful. Its value as a stored form depends entirely on the context of disruption. This makes it a complement to cash, not a replacement for it. Cash provides immediate transactional utility. Physical metals provide longer duration stored value that retains worth when the currency itself is under pressure. 3. Physical commodities with direct utility value. This is the category most people dismiss as extreme preparation, and the dismissal ignores what the historical record shows about what actually functions as exchange medium during disruptions. During the Soviet collapse of 1991, cigarettes functioned as currency in many parts of the former Soviet Union, not because anyone had planned it, but because they held portable, divisible, universally desired value that didn't depend on any system to remain valid. In post-war Germany, coffee beans, cigarettes, and chocolate functioned as transactional currency before the Deutsche Mark was introduced in 1948. The modern version of this principle is not stockpiling cigarettes. It is recognizing that goods with broad utility, non-perishable food, fuel, basic medical supplies, tools, function as stored value that retains direct worth when monetary systems are disrupted. In Puerto Rico after Maria, people who had fuel stored in physical form could power generators. Generators meant functioning refrigeration. Functioning refrigeration meant preserved food and medication. That supply chain of stored utility value was worth more, in a practical sense, than equivalent dollar value sitting in an inaccessible bank account. This is not about extreme scenarios. This is about recognizing that in any disruption event lasting more than a few days, the value of direct utility goods increases relative to the value of monetary claims on a frozen system. 4. Accounts at multiple institutions, including credit unions and non-bank financial institutions. If the failure is specific to a single bank or network, rather than systemic infrastructure, diversification across institutions provides resilience. This is a straightforward principle that most people apply to investment portfolios, and almost no one applies to basic transaction accounts. A bank failure or system outage affects its own customers. It does not necessarily affect customers of other institutions simultaneously. The RBS outage in 2012 affected RBS customers. Customers of Barclays, HSBC, and Lloyds continued to transact normally. The people who had accounts at multiple institutions could access their money through other channels while RBS resolved its failure. Credit unions operate on separate core banking systems from large commercial banks. They are not connected to the same interbank infrastructure in the same way. A failure of JP Morgan's payment processing system does not automatically disable a local credit union systems. Geographic diversity of institutions matters as well. A disaster that disables banking infrastructure in one region may not affect institutions domiciled elsewhere. The practical implication is simple. Concentrating all transaction capacity in a single institution creates a single point of failure. Distributing across at least two independent institutions, preferably including one smaller, locally operated institution on different systems, creates redundancy that has historically proven its value in multiple documented disruption events. 5. Stored value that exists outside the banking network entirely. This category requires precision because it includes both historically proven mechanisms and newer ones whose long-term resilience is less established. Prepaid cards, reloaded in advance and stored physically, represent a form of value that can sometimes function when bank-linked cards cannot. They do not depend on real-time authorization from your bank's system. They carry preloaded value in their own processing networks. In some disruption scenarios, they have functioned when bank-linked cards have not. In severe infrastructure disruptions, they may fail for the same reasons. They are not a complete solution. They are a layer. Gift cards from essential retailers, pre-purchased and held physically, represent stored purchasing power at specific merchants. Their limitation is their specificity. A grocery store gift card has value at that grocery store and nowhere else. But in a disruption context, that specificity can be an advantage. It represents stored transactional capacity at exactly the point where you most need it. Barter networks and community exchange relationships. This is the category that resists being put on a spreadsheet and therefore the one most people ignore. The historical evidence on this point is overwhelming and consistent. In every documented financial disruption, from Argentina in 2001 to the Soviet collapse of 1991 to the immediate post-war period in Germany and Japan, informal exchange networks built on trust and existing relationships formed the transactional backbone for communities when formal systems failed. The people who survived best were not those with the most assets in the system that had failed. They were those with the most relationships outside it. Now here is where the modern context makes this analysis sharper than anything in the historical record. The digitization of money that has accelerated over the past 20 years has created an asymmetry that previous generations didn't face. In 1933, when Roosevelt declared a bank holiday, the average American family had meaningful amounts of cash in their home. They used cash daily. They were accustomed to physical transaction. The bank holiday disrupted their access to savings, but their daily transactional infrastructure, cash, continued to function. In 2024, the average American household holds less than 2 weeks' worth of cash reserves in physical form. A significant percentage holds virtually none. The entire transactional infrastructure of daily life, groceries, fuel, medication, utilities, has been migrated to digital systems that require continuous, uninterrupted operation of interconnected networks that are more complex, more interdependent, and more vulnerable than at any previous point in financial history. At the same time, the attack surface for that infrastructure has expanded dramatically. The number of nation-state actors with the capability to conduct sustained cyber attacks on financial infrastructure has increased. The number of ransomware incidents targeting financial institutions has increased. The Federal Reserve's own financial stability reports identify cyber disruption as a top-tier systemic risk. The Bank for International Settlements has published research on the potential for a single cyber event to propagate across interconnected banking systems in ways that would dwarf any previous disruption. And over 130 countries are currently developing or piloting central banked digital currencies. These instruments, whatever their other properties, represent the most complete concentration of transactional dependency in centrally controlled digital infrastructure that has ever existed. A programmable digital currency controlled by a central bank is not more resilient than physical cash during an infrastructure failure. It is less resilient because it requires that infrastructure to function at all. An outage that takes down a CBDC system doesn't just disrupt your access to money, it disables money itself. The trajectory is clear. The direction of travel in monetary systems is toward greater digitization, greater centralization, and greater dependency on infrastructure that requires continuous operation to function. The consequence of any disruption to that infrastructure grows larger as the dependency deepens. Let's return to where we began. Verona, 2003. The grid failed, the digital layer went dark. The money was real, and the money was inaccessible. 18 hours later, it came back. But here is what the owner of that small business in Verona told himself when the lights came back on, if he was paying attention. He told himself that next time, he would have physical cash in the drawer. He would have an account at a second institution. He would know which of his regular suppliers could operate on delayed paper invoicing. He would know which of his employees had enough cash reserves to bridge a short disruption. He would have enough physical redundancy in his transactional infrastructure to function, not forever, not in a catastrophic collapse, but through an 18-hour outage, through a 2-week banking system failure, through the gap between when the digital layer stops working and when it resumes. Because the question is not whether digital banking will go dark. The question is how long it will be dark when it does, and whether your financial life is structured to function during that window. In 1929, people trusted banks they had no reason to distrust. In 2003, Italians trusted a grid they had no reason to distrust. In 2012, RBS customers trusted a bank that was technically solvent. In 2019, TSB customers trusted a bank that was technically safe. In every case, the money was real, the trust was reasonable, and the system failed anyway for technical, not moral reasons, for infrastructure reasons, not fraud reasons. The modern financial system is not evil. It is not a conspiracy. It is a machine, an extraordinarily complex, deeply interconnected machine that runs on electricity and software and uninterrupted communication between thousands of nodes. And machines fail, not because anyone intends them to, because complexity produces failure modes that no one anticipated, because infrastructure ages and is attacked, and sometimes simply stops. The question is not whether you trust the machine. The question is whether your stored value depends entirely on it to function. Because the machine works almost all of the time, and almost all of the time is not all of the time. The gap between those two phrases is where the people who were in Puerto Rico in 2017 spent weeks. It's where 1.9 million TSB customers spent a month. It's where the business owner in Verona spent 18 hours that felt like considerably longer. And the gap keeps widening. Not because banks are becoming less safe, but because our dependency on the digital layer has deepened to the point where any disruption to it, from any cause, leaves the average person with no transactional capacity at all. Physical cash in appropriate denominations held outside a single point of failure, precious metals in accessible, recognized form, goods with direct utility value, accounts at multiple independent institutions, relationships and community networks that don't require a functioning payment terminal to activate. These are not extreme measures. They are not signs of paranoia. They are the historically documented answers to a straightforward question: what functions as money when the digital layer goes dark? Every generation believes its infrastructure is permanent. Every generation is wrong about that in at least one of the ways that matter. The question is not whether the lights will go out. The question is what you have in your hands when they do. This channel exists to examine the answers that history has already given us, before those answers become urgent. If that is the kind of analysis that is useful to you, consider subscribing.